Well, here we go again. All the talk on Wall Street this summer was all about the Federal Reserve stopping its tightening policy. Yet here we go, where the narrative has changed. And now we're talking about not just one Fed rate hike, but possibly two before the end of the year. And who knows what that means for the rest going into the new year. So we will see. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and hot Scottsdale, Arizona.
It's less hot, Todd. It's less hot now.
Less hot. Well, it's hot in New York, I got to tell you. I mean, it's a scorcher here. But we have a very special guest with us today, and we really hope that she's going to be able to bring a lot of the answer a lot of the questions that we have regarding this market, because we know that you have them as well. We have with us Katie Stockton. She is the founding and managing partner of Fairlead Strategies out in beautiful Stamford, Connecticut. Welcome to Buy, Hold, Sell, Katie.
Thanks so much, Todd. Good to see you both.
Likewise. Well, I got to say, you have been, you're a subject matter expert. Everybody knows this. You're all over the news, and everybody has you as their featured guest. So we appreciate you taking the time. Maybe if you could take a couple of minutes and just let the audience know what you and what Fairlead Strategies is all about.
Yeah, thanks for that. Fairlead Strategies is probably best defined as an independent research provider focused on technical analysis. So we do publish research reports. In fact, I think we have 7 different ones that we're publishing once a day, once a week, et cetera. And our client base goes from an individual investor all the way up to a large asset manager. And we do consulting around that as well. And last year we launched an ETF. So I'm a portfolio manager for the Fairlead Tactical Sector ETF, or TACK, TACK. And that's our primary focus, but all technicals all the time. We believe technical analysis is essential in investing and complementary to other disciplines.
Well, you're definitely busy, that's for sure.
That's awesome,
yeah, it is
Judy.
awesome.
So now we get to the real point. What the F is going on here? And, I'm looking at, I'm just blown away how Apple drives the QQQ, how Apple drives these indexes. And now I've built my QQ. It's everything in the 100 except for Apple, just so I can get a sense of that. Does it bewilder you, or is it the technicals that are on the technicals?
Yeah, well, it's definitely an impact, right? It does mean something, because we see a day like today, even where Apple's impact probably makes it look a lot weaker than the day actually was under the surface, just given its heavyweight sort of footprint. It used to be that we could get data really easily on what the market movers were. And now all the data sources are being a little bit, sort of stingy with that data. So we have to just back into it and understand and respect, the impact that these heavyweights have. And it's been a real sort of challenge, I'd say, for folks this year, because, earlier in the year, it certainly veiled what was happening under the surface. So I think at year end, or if not already, a lot of people will say, well, wait a second, it was a very strong year, but why doesn't my portfolio look very strong?
Katie, I was looking over the research that your firm had sent over, and high quality research, by the way. So definitely want the audience to check out fairleadstrategies.com for that. But with that, I noticed how bearish that you seem to be, especially in short term. You're talking bearish, but even longer term, it doesn't seem like there's a lot of optimism. Did I misunderstand what I was reading, or is that your take?
No, well, you're kind of catching it at a bad time, is the way I would put it, Todd. So we've been bullish really since, I'd say, May, when we saw the major indices break out. But in August, we saw enough of a loss of momentum. So it started out as short term, and then it started to affect the intermediate term gauges as well. So we moved to a bearish bias, short term, intermediate term, and we're kind of in the midst of that. So that's where you're catching us, sort of in this interim bearish position within what we have had for a while, which is a neutral long-term context, because we're treating the cyclical bull that's manifested itself in the major indices this year as a sort of move within a broader trade waiting range. If we were to see the S&P 500 break out, we're watching 4,600 as a resistance area for one, that would be a positive development. Our work is very dynamic. If something changes, we're going to change with it. And that can be frustrating for some other, folks that are publishing on macro research, and they say, well, how can it change so quickly? We're momentum followers. And while we can't always explain moves, we're not the why people, we're more the what people. If it changes, we want to change with it.
Katie, every day now I check what the total algorithmic trading volume was. I get it like at 4:05 after the close of the market, right? Today, 74% of all trades were basically an algorithmic person who probably subscribes to your data and then puts it into their algorithm and says yes, no, yes, no, yes, no 1,000 times. I spent some time with Renaissance Technologies last year, completely blew me away, right? They're making trades every 5 seconds or milliseconds. But just the impact of having so much algorithmic trading as the total volume, is that why you're so technically oriented? Because the fundamentals are basically thrown out the window?
The technicals are always valid, right? If we're wrong, it's not because the indicators are wrong, it's because of our interpretation of them. It's really math, right? So we're very comfortable with that approach to markets. It doesn't mean that fundamentals aren't important, nor macro research or political inputs. I think those are the drivers, the driving forces of these trends. In addition to, and here's the rub, it's market sentiment. So the behavioral element of the market participants is hugely impactful. And that's where you do find sometimes, fundamental analysts might get burned or certainly frustrated when they can have a very sort of solid and respectable opinion and view based on the data that they have, which, by the way, we're both looking at historical data. And yet they're just disjointed from the market. And I think it was Tom Dorsey, one of my old mentors in college, in fact, who taught me, he said, 70% of the move in any given stock is driven by the market and its sector. And that was just sort of a number to throw out there. But the impact of that comment is really quite big because, it is forces like what you're talking about that create that. And so I think it tells us we need to respect the top-down inputs, always look at the major indices and have an understanding as to whether you feel like you're on the right side of the prevailing trend over the time horizon that you're trading.
Katie, do you give your clients, I haven't seen your research as it comes out, but do you give them a time horizon on your, trend? Because I have one account that the firm I manage, and our agreement with the owner of the account is that we're only long when the certain things are all above the 50-day, because she just can't take the pain for anything, right? I mean, she would be your perfect customer. And we were, we've been like crushing it this year. But as soon as the S&P, and she calls me and says, Tobin, the S&P's under the 50-day. What's going on? I said, well, you're in cash or you're short. I mean, do you get that specific with your call?
Yeah, for sure. And you actually bring up something really interesting, like a behavioral element, right? With that, because the 50-day moving average, we see that as a good gauge of the sort of short to intermediate term trend. If it's trending higher, well, your probabilities are better on the upside and vice versa. And so someone who's hyper-focused, and it's not just someone, it's a lot of computers that are hyper-focused on these levels that are very easy to track and to program. That's why these levels matter in a way. I don't want to call it self-fulfilling, but it's a behavioral element, because people say, well, if it breaks the 50-day moving average, that feels like enough of a trend shift that I want to manage risk through that. And so it's not out of line with the kind of sort of calls that we make. Ours are based on things like the 50-day moving average. We have a methodology that adheres to trend following gauges like that, and overbought, oversold measures and relative strength, also market internal measures like breadth and sentiment. Those are all inputs, and we approach it really very systematically in the same way that your client really is. And, if you can just have, I mean, very simply, like a long-term trend following gauge on your side, it doesn't have to be this full methodology like we have. I just think you'll be well served by that. And you've seen that in real time this year. I think that, it will help you minimize the drawdowns, and the drawdowns are the killers.
Yeah. Well,
Okay.
the other thing that always I get a pushback on is, yeah, but it's in a taxable account. So, if I'm changing, if I'm just trend following, I'm going to pay here's a technical term, a shit ton of taxes, because I run sort of $5 million, $10 million portfolios. And so, they'll say, hey, I understand, hedge for me. I'll take the taxes on the hedge. Hopefully I make the profit on, but I can't. I mean, how do you get over that argument? Because I never win that argument.
Yeah, and listen, like I think now, with all the new products on the market that provide sort of hedged equity exposure, I think we have much more options. So when we recommend hedging, which we do in times like this, and we always give a time frame. We're saying, in fact, right now that we'd be hedged really with a target of early October, so to get back to what we feel like is a fuller equity exposure. So we're maybe more bearish leaning short term, but we feel that this will yield a buying opportunity. So with that in mind, should people go out and sell all of their stocks that they have good gains in? No, absolutely not. So we recommend hedging strategies like buying inverse ETFs for one.
Sure.
It's an opportunity for me to sort of plug an ETF like ours, TACK, in that we have the ability to do asset allocation and also sector rotation within an ETF wrapper, which then provides that sort of ability to avoid the tax implications of doing it yourself. So some of these active ETF strategies like ours will give you that nice tax wrapper that the only, you're not going to get the capital gains distributions like a mutual fund.
Right.
You're not going to incur, say the rotation from XLK to XLP or something of that nature.
Todd, I just want to let you know that that was not a setup on my part. Okay.
Well,
but I appreciate it anyway.
It was a layup, but it was not a setup. Okay.
Well, I want to follow with that, because on the ETF, you mentioned the sector rotation. I am curious, which sectors are you tracking or trading inside that ETF?
I mean, we have the 11 major economic sectors represented by the SPDR ETF. So think of it as a fund of funds in a way. And in investing in those, we feel that we're getting exposure to the likes of Apple. The market's rewarding. We have to trust this, right? Because we're not fundamental analysts, but we're trusting that the market's rewarding the best companies with the biggest market cap. And it's maybe being too trusting at times, but we invest in these 11 major economic sectors, and we'll equal weight them when they're fitting our sort of trend qualifiers. And it's a very long-term strategy, slow moving, designed to avoid, getting drawn down in the 2008s and 2022s of, the secular bull market that we tend to see the market adhere to. So we want to ride the uptrends when they're affecting our longer term indicators in a way. And if those sectors aren't fitting the bill, we will move into a combination of short-term treasuries, long-term treasuries, and gold, also via ETFs. And that's simply to minimize drawdowns, to take the standard deviation lower beta. And in a way, over history, it becomes something close to like a 60-40, 70-30 type of portfolio, but it's all doing it for you. It's all dynamic.
Well, and Katie, I love standard deviation. I'm a standard deviant, right? We follow a lot of various industries and companies, so on and so forth. And some of the strategies that we've been using have been to use options instead of cash. In other words, but when I'm getting 5.5% out of the Interactive Brokers account, then we're using options to give the person the upside. But the standard deviation is about 2 or 3 times less. And that's, that's getting a little into the weeds, but I'm definitely going to look at your fund, because I love the idea of having long exposure, but just having it at a much less degree, but getting the ups, but not having but getting those ups with 3 or 4 times less risk is what I'm trying to say.
That's exactly right. And that's, it's sort of our, I guess, nature in our research as well. Our methodology is designed primarily, honestly, to help people manage risk. As much as I'd say, probably get a reputation in the media as being a forecaster, because that's what they're asking us. They say, where do you think the S&P 500 is going to be in a month? That we can infer some things from our indicators, but we don't know. We're just trying to put probabilities in our favor. And also we're trying to understand where the, sort of the market changes, right? We want to know not just what the prevailing trends are, but is it enough of a loss of momentum to dictate some repositioning? What was interesting in developing our models, and this happened sort of later in my career, I discovered that it made so much sense to be much more long-term in focus. I would have hoped I would learn that earlier in my career, but but we do get caught up to a very high degree in our research in the short and intermediate term moves, and yet as an investor we really believe that the long-term sort of investing makes a lot of sense.
Yeah, Toby, I want to interrupt you there because we're going to go to the break, but that is one thing that investors do not actually look into, is the managing of risk. They're just simply looking at the managing of the returns. It sounds like you're focusing on that management of risk, and that really is prudent. That helps the investor clearly over the long term, and I think that's something that gets forgotten by investors, especially on when markets are trending higher, of course. But listen, we're going to leave it there on this block. Coming up in the next block, we got to ask Katie all about Treasury yields. We got to get into some of the bullish areas that she's looking at.
Energy. We need to know where oil is going.
We got to talk about momentum plays. We have a few other surprises as well. So sticking with us right now is Katie Stockton. She's the founding and managing partner of Fairlead Strategies. You definitely want to go to fairleadstrategies.com, see what Katie is writing about and their entire staff. It's wonderful stuff, high level, high quality, something that also is forgotten on Wall Street sometimes, but they're cornering it right now.
Todd, what are you saying? My research is low quality? Is that what you're saying?
I love your research. I read your research all the time. It's the best research out. Next, you and Katie are 1 and 1A right there. All right, listen, stick with us after the break. We'll be right back.
Girl, it's been way too long. I got to get back in my zone.
I mean, let's talk about today when we go topics.
Roll it down.
I am.
You don't need a car to listen to Sirius XM. You can listen anywhere. You know that, right?
What? Kevin Hart's Laugh Out Loud Radio.
Kevin, you could use your phone.
What?
Alexa, play Kevin Hart's Laugh Out Loud Radio on Sirius XM.
What?
This is how I know you're getting old. I guess that was it.
What does it mean to be a leader?
It's taking my first solo flight.
At the University of North Dakota, we lead our own way.
Welcome back to Buy, Hold, Sell. With us today is Katie Stockton. She's the founder and managing partner of Fairlead Strategies, and also joining me is Tobin Smith, of course. And Katie, when we left it at the end of the block, we were talking about managing risk, but we were talking about on the equity side with your ETF that you're managing. Let's start talking about bonds and treasuries right now. So you have the 10-year yield right now. It actually is a little higher. We saw bonds sell off. We're at 4.25% right now. How high are your charts telling you that 10-year yield is going to go?
Yeah, I mean, and I try to look at it really very strictly from a technical perspective, not because we're the driving force of any of the move, but we just want to try to understand it from a trend following perspective. So when I throw out a number, that number has nothing to do with the Fed, right? Yeah. Or anything, or any policy. It's simply where we've seen yields top out perhaps in the past. What we feel on yields just more broadly is that we've seen a secular shift that we hadn't seen in decades. So for a lot of us, or I don't know, I'm sort of on the cusp, but it's unlike an environment that we have ever experienced, where we're expecting yields to work higher over time. We can see within that context, yields come in for a couple of years and then resume higher. But we do believe, based on the longer term downtrend channel that had been in place since the 80s, that now we're seeing this advance. And with that in mind, we want to trust that there's more upside for yields over the long term. And that's our context. But, when we evaluate the shorter term gauges on the 10-year yields, we're looking for consolidation. We publish on them on a weekly basis. And obviously, we're involved in them as well. The consolidation phase, we suspect, will be essentially a pause to refresh the uptrend. We've already seen some of that from earlier this year. 10-year yields have resistance, so a place where they've topped out before around 434. And if we were to see a breakout above that level, and we always look for breakouts to be decisive, like a couple of weeks above, and Toby, you'll appreciate this. That's largely because of the machines that game the levels that are so widely followed. When we get that decisive breakout, and here's my number, 5.25 is the next level of resistance. Yeah, see, your face is like many macro strategists I talk to. It can be a shocking number, but listen, we've been there before.
Yeah,
it's not necessarily a target or an objective, but it's just simply the next level of importance on the chart. And I don't think we can rule that out in the coming, maybe it's a year or 2 years. But in the interim, we are looking for some signs of upside exhaustion that we have from our overbought, oversold metrics to yield some consolidation in yields, and therein some stabilization in the Treasury market.
Well, for everybody at home, understand this. If Katie's right, and the 10-year goes to 5.25, that means the 10-year bond that you own is going to depreciate 18%. I mean, people don't quite understand that last year, the pension guys who just basically live on, if I could just make 8% a year, I can actually pay my pensions. They lost 24% in their bond portfolios if they did not hedge them. Now, no one, I guarantee you, other than me here, was alive when we had, when I was selling 17% yielding bonds, Katie, to pensions in 1982 at 30 years.
Long time ago.
30 year, and telling them, if you just would shut up and listen to me and buy these 17% yielding 30-year, that bond will be worth 8 to 10 times what you're paying for it now, and you will have gotten 13% or 17% for 30 years.
Right.
And they all looked at me like I had 5 heads. And when you haven't had this big, that's pretty scary. But what you just said is, this is what always gets me. So the private investor says, I'm going to buy the safe stuff. I'm going to buy safe bonds. And then a year later, a client comes to me and says, Toby, I'm down 24% in my blankety blank Merrill Lynch safe bond fund. And they didn't explain that to you, Tommy? No, they did not explain it to me, but I'm down $2.1 million in my bond fund.
Yeah.
We're now in the stage of the show where Toby's doing the impressions. But Katie, if we do see a 5.25% hit on that 10-year yield, I mean, what does that mean for the markets?
Well, I mean, you'd infer that it's not good for equities.
Right.
What's been really
There's no
interesting
Santa Claus rally.
Of late, what we've seen is that it's more the velocity behind an up move versus an up move itself that seems to be a hit on equity market sentiment. So maybe if we see a grind higher over time, it'll be less impactful to equities, or maybe it will certainly just affect, the interest rate sensitive sectors, but perhaps others will be able to forge higher. Whereas if it just busts through and it does so in dramatic fashion, well, that could be pretty painful. And it's an environment we'll just have to adapt to if we get to that place. And I think if yields do break out, which we think they ultimately should, that would maybe be a challenge to the major indices in reaching new highs. So that's why we're still at that kind of neutral long-term bias until we see these proof points to suggest that, okay, we're kind of out of the woods now. Does it mean that if we see a breakout in equities, we're still going to believe that? We don't want to become sort of married to historical correlations in a way, but rather respect trends and momentum as they're unfolding. As an example, Toby, you mentioned energy, right? So we can talk about energy in this sort of line of thought, in that, is an energy breakout necessarily good when it's related to crude oil breaking out? And does that mean something else should be going down? Or what does that mean for the sort of macro takeaways? It's more like, nope, we see a breakout in energy and we want to take advantage of it. So we don't get too caught up in the intermarket relationships when we're talking about intermediate term trading, but we certainly keep them in mind when we're talking about the long-term outlook.
Well, I mean, let's just say quickly that long duration assets, which is a very wonderful way to say tech stocks that don't have earnings, and so they're discounting them 30 years into the future to come up with, the fakakta idea of what they value these things at. It has to have some correlation, because Todd, there's a correlation math that we use. If we were at 5.25 on the 10-year, that would have the QQQ down about 18%, is roughly how I do the math. And that would simply be because of the present value of those future earnings has to be discounted at such, such a high rate, and blah, blah, blah. So now I'm getting chills down my back. 5.25. Okay, Katie, listen, we have to have you on.
Well, how about this? So to manage that risk, right? What about applying a very simple trend following gauge, right? Where we can judge that, the 50-day moving average, maybe it's the monthly MACD indicator, which is one of our preferred gauges.
Yeah.
If that changes, that's going to be information that there's enough of a shift underway, irrespective of the driving force, yields or otherwise, that you need to be managing risk. So it just gives you a sense of, do you want to be more risk on or risk off in your positioning? And then to have the macro context and realize that wow, history would justify that kind of pullback, then that should, in a way, make you more respectful of any kind of loss of momentum. So I think of it as a great way that this is sort of the complementary nature of the discipline, where if someone has these macro views and they're based on, very good data, long-term, et cetera, well, then they should be all that much more respectful of any shift.
I mean, again, the context, however, is when we raised rates to 16% and my mortgage was 15% in 1982, the entire debt of the United States was about $238 billion. Today, we've just, and the average rate of a bond has been 5.25% for basically forever until we went to free money, right? So now we're raising rates. If we go to 5.25, then all of a sudden the debt service of the United States of the federal goes to 8.5 or 9%. Number one. And number two, the reason why those interest rates would be going up is we're going to have to issue another $8 trillion worth of bonds to meet all our deficit spending. So there is no historical context for having a $25 trillion economy with a $40 trillion debt load paying 5.25%. I mean, I think that would be as bearish a scenario as you could make for the stock market, and in my humble opinion.
Yeah.
And that's why that number does get the shock value. So I'm well aware of the reaction that it elicits.
That's a headliner.
We'd be doing this. I would have my gold teeth rack on. I like gold.
So real quick though, Katie, before we close out the show, I want to ask you this. You were very bullish in your recent research on home builders, and with rates going up, is that it seems to be an oxymoron there, that you would be actually bullish on that side?
No, this week we've been more bearish on home builders.
Okay.
So we did publish a chart of ITB, one of the ETFs representing the space. And we wanted to present it as a long-term uptrend and kind of respect that it's been very, very strong, but also to highlight the loss of momentum there. So because it has become a bit more of an intermediate term reversal to the downside, more significant than what we've seen for a long time. time. And so we want to respect that for exactly the same reasons that we've been discussing, right? So it was more to say, okay, we want to be hedged right now. We want to be reduced in exposure. At some stage, we do expect and we trust the market to trend, right? So we suspect that the uptrend will resume. But the overall takeaway, and this is somewhat in following with, let's let the market prove itself to us. We feel that the next buying opportunity, it may not have a ton of shelf life, right? Because if we do see resistance discovered quickly again for reasons perhaps related to yields, well then, at least we've been there, right? At least we have the opportunity to take advantage of an up move. But we're not ready to say that we can, kind of buy and hold. So that's why some kind of rotational strategy makes a lot of sense. Something that has, a little bit of balance to it, where you're finding lesser correlations from different asset classes. Gold is a great example of that. And to have almost like a barbell type of approach to the markets.
And so
That's
quickly,
great.
Katie, on a positive note, what are you buying, or if anything, what are you?
Well, yeah. So recently on CNBC, I recommended the uranium space.
Yes, and I took your advice,
Excellent.
by the way.
So you can see I had to dig kind of deep to get there to get something to recommend. So we are buyers of gold. We are buyers of selected areas within sort of the energy and commodities complex. We're constructive, but not necessarily the long-term time horizon. But for now, we feel fairly confident that we have some upside there. Otherwise, we're just waiting for the entry. We take top-down inputs, and sort of within that, we want to make sure that we have the odds in our favor. So we're going to wait until the market tells us to get more exposed, and then we'll revisit what we feel are the leading sectors of the market: technology, communication services, mega caps. But even, I don't know if you all have noticed, but as of late August, I mean, we actually saw miniature breakouts. Well, no, in the small and mid cap tech space. So something like a Splunk or an Okta, some of these, higher growth, high beta, areas of the market that you would suspect should have been more challenged, people flocked right back to them. So in a way, it's probably just something that we can take advantage of, again, short term. But it could at least lead to a better finish for this year for Q4.
Hey,
Okay.
quickly, Todd.
Yeah.
I on days like yesterday, even today, if I had the time, but I look at the tape for like the last hour, and because we're heavily involved in technology, and right to Katie's point, while Apple's down 4%, anything else, the software as a service, enterprise software as a service companies are down 50 cents. They're 200, no one was selling those.
Yeah.
And that's why it seems to me that the algos are in such control here that they don't care about that stuff. But they, when they see the move, they accentuate the Apple move. They accentuate, the Amazon move. And yet, Okta, to your point, ServiceNow was, up $3 yesterday when everything's caving. There's some real strength in there. And when next time we have Katie back on, we'll get a couple of the software as a service.
I mean, it just seems to be a space that people gravitate towards for beta. And that probably will be the case on the next step move once we get out of this correction.
Cool.
Absolutely. Well, we're going to leave it right there because, Katie, we could talk for hours about this stuff. We have so many other subjects we'd love to address, but we're going to close out the show with this. So with that, Katie, thank you so much for joining us today. You were fantastic. We definitely hope to have you back on the show, and we could follow up on some of those other subjects. So on behalf of Katie Stockton at Fairlead Strategies, please go to fairleadstrategies.com. See what Katie has to write about, all the research from her and her crew. It's excellent research. And of course, Tobin Smith, tobinsmith.io. Toby, I gave you a plug. I had to throw it out there.
Jeez, I got to beg for it, Frank. Did you say go to tobinsmith.io?
Yes, tobinsmith.io.
Oh,
yes,
Go
tobinsmith.io.
check it out right now.
Go check it out.
Check it out. Everybody, we're going to crash the server. Absolutely. So Katie, thanks again for joining us, and we definitely will we'll catch you next time. And coming up next on the next show, we have Jeffrey Hirsch from the Stock Traders Almanac, a show you definitely don't want to miss. He's going to tell you all about what history tells us about September.
And
So,
he's been
thanks
dead
again
right
for
on
joining us.
September.
Yeah.
Look at Katie had. She's got them right there. That's awesome. So, that's
Cheers.
great. All right, thanks again for joining us. And take care. We'll catch you next time.
Buy, hold, sell, brought to you by Crosscheck Management.